After a rather red week from the S&P sliding to the NASDAQ experiencing one of its worst single-day declines since 2022, having faltered by almost 4%, I know what the vast majority of you are probably thinking. Is it time to buy or hold off? And if you're any sort of real investor, you know that the answer is always it is time to buy. So after I break down some of our need-to-know, most pressing economics with you, I want to go ahead and double down on 6 dividend stocks that should most definitely be on your radar, if not immediate buys when the market opens by tomorrow. Ready? So let's go ahead and kick into gear here with our macro story. Get that all sorted out in order to have a better understanding of why we've been experiencing all of this ebbing and flowing rather recently, and most importantly, what we can actually expect moving forward. Now, depending on the index that you're most focused on, whether that's the S&P, the Dow, or the NASDAQ, you would have experienced a vastly different week. Just to speak once again to this past week's overall performance, the S&P dipped just a tad into the red, but not even down by a full percentage point. Whereas on the flip side, the NASDAQ plummeted by almost 4%. That's all very likely from a lot of these institutional investors realizing that tech, which has for many just been in a bubble, is way too overpriced, very expensive, and profits should be taken. No, I'm not telling you to sell out of your tech positions, but I am saying that's what a lot of institutional investors have been doing. That really just clues us into the fact that the NASDAQ nosedive stemmed from the institutional investors as they throw more money into safer bets as this AI craze is really dying down. However, I say that the real focus still remains or should remain on the Federal Reserve. Powell has been saying, and ultimately for a while now, that really interest rates will need to come down. Now, when the Fed speaks, the market reacts. And also this past week, we have to note that Powell spoke at the Economic Club of Washington and shared that the Federal Reserve didn't exactly see what they wanted to in the first quarter. But then following the second quarter and even data from this past week, well, the Federal Reserve gained more confidence in the data that they were looking at, meaning interest rate cuts should certainly be coming sooner rather than later. He also said and made it abundantly clear that if we leave the rates where they are for far too long, it's going to cause some economic troubles. So I just want to share that we're in a very interesting point in time. You see, should we actually see those rate cuts soon, all indices, Dow, S&P, and NASDAQ are going to soar, given the cost to borrow and spend will be easier, as well as the cost-cutting measures will be replaced by budgets that these companies are just going to splurge on and have more money to spend. The reality here is I foresee a bull run coming, especially as Jerome Powell just keeps on talking about these interest rate cuts coming soon. But it really means quality, quality, quality in all the companies that we're investing into, the companies that you can invest into now and just hold on to. I want to also go ahead and share with you that these 6 dividend stocks right now, based on our macro environment, are all off their peaks, trading on a bit of a discount and just ripe for your investment. With that, let's go ahead and get to dividend stock numero uno, Snap-on, ticker symbol SNA, which is a manufacturer of various tools and equipment, as well as systems for professionals across verticals, serving customers in the aviation and aerospace space to your everyday run-of-the-mill construction, mining, and natural resource spaces. Now, in knowing that you can probably deduce their sales have all declined over the last few months, resulting in a lower stock share price, which is the case here with Snap-on. It's trading right now for $275 per share with a PE at 14.2. That's overall down on the year from $294 back in March. But I like a company like Snap-on as it's a necessity in our everyday lives, and it's flying under the radar. I mean, zoom out, we see over 177% worth of share price appreciation over the last decade, and right now, analysts remain optimistic as we look ahead to these interest rate cuts and increased spending that will likely occur from all of Snap-on's customers. So we get a forecasted share price hitting $301.33. That's about 10% worth of upside. But in any case, shareholders are also going to enjoy a 2.7% dividend yield that's been growing quite nicely at 10% year over year, while maintaining an 85-year uninterrupted dividend growth streak. And while Snap-on really focuses on the nuts and bolts, if you will, of the construction industry, Caterpillar, ticker symbol CAT, is a whale within the construction industry. Matter of fact, it's the world's largest manufacturer of construction engines and machinery, and it's just in a very similar boat as Snap-on. I mean, we're talking about delayed or terminated projects on the federal, state, or municipal level, while the housing market has just been absolutely destroyed, meaning sales have been declining for Caterpillar. An opportunity for us is now here. Share price at $357 per share. That's down from $360 $177 back a few months ago, and a current PE at 16.3. But zoom out here, we get over 324% worth of share price appreciation, and that should Trump be the next president. Not to get political here, but he very well may be. I would imagine he's going to put a hefty sum of resources into infrastructure, especially in his second term. Either way, analysts are very bullish on Caterpillar, coming in with a forecasted share price of $372.70 per share. And until the bounce back, just a rock solid dividend coming in at a yield of 1.58%, making for plenty of growth ahead, as that growth rate for the last 20 years has averaged 10% and has gone uninterrupted for the last 31 years. But if you want to stay out of the construction industry entirely, perhaps even head north to our friends in Canada, I'm going to go ahead and encourage you to look into Canadian National Railway, ticker symbol CNI, which operates railway for freight servicing both in Canada and in the United States, in the Midwest and in the South. Now, as we speak, the company has been really hit with higher expenses related to network maintenance, as well as higher costs overall from labor, purchase services, and equipment impacting Canadian Rail's bottom line. So go figure, the stock is hovering right now around $123 per share, down from $132 per share back in March. PE ratio coming in at 19.8. Zoom out with me to see Canadian Rail's reliability over the last decade, delivering 111% worth of share price appreciation, which has all triggered the insiders to buy more shares worth of the stock, on top of smart money with plenty of hedge funds who have been investing into the company to score over 242,000 shares last quarter. And as for the analysts, almost 9% worth of upsides expected, bringing the share price to $134.04 per share. But until then, you're going to get the benefit of a safe dividend to rely on, with a yield coming in at 2.01% that has been growing impressively here by 16% year over year for the last 20 years, while maintaining a 27-year dividend streak. Now, investors, there's 3 dividend stocks and we got 3 more to go. But before I cover them, for the life of me, I cannot figure out or understand here why 70% of you out there are watching the videos but not subscribed. We've made plenty of progress to get that number down to where it is today, but it's still not good enough. The goal is 50%. So I want you to go ahead, tap on that subscribe button to join me here. As this channel grows, I'm going to put more focus on delivering through on more stock ideas, market insights, and of course, better masters of the market guests, all for you. With that, back to it here in the USA, and we're going to talk about a logistics company with United Parcel Service, ticker symbol UPS, which has been absolutely crushed over the past year, plus from all of our macroeconomic events and all around just costs to operate a logistics company. Nonetheless, my conviction in UPS stems from their dominance in the industry, from sea to ground to air, and right now, while the stock has really just been all over the place, it really is still trading at a great discount. $147 per share, PE at 20.6, zooming out over 93% worth of growth there, but plenty of volatility during that time, to which I'm doubtful that that will last over the long term. After all, analysts are right there with me, projecting a bounce back for the share price to climb to $161.86 per share. That makes for about 10% worth of upside from here. And until then, a whopping 4.42% dividend yield to collect on, boasts a 55-year track record while growing by an average of 10% year over year. However, if you really want to play it a bit safer, or I should say a lot safer, there is still time to load up on Pepsi, ticker symbol PEP. And a matter of fact, no better time to do it after it just slid from its highs back in May, from $181 per share to $169 today, after the company couldn't really get their act together from that weight loss product line flop and just overall consumer trend shifts. But investing is not about today or tomorrow, it's about the long term. So go ahead and zoom out with me to see over 154% worth of share price appreciation over the last decade. Now, here's the deal. Iconic name and diversification when it comes to their pipeline and soft drinks and salty snacks. I think they're here to stay. Analysts agree. They project over 7% worth of upside, or almost 7% worth of upside, climbing up to $181.33 per share. But it's the hedge fund activity that continues to pull me into this one, with 150,000 shares purchased last quarter by smart money. And until consumers actually enjoy spending freely again, shareholders of Pepsi are just going to continue to receive a very refreshing dividend, thanks to that yield coming in at 3.19%, which has been ongoing now for the last 59 years, and it's been growing there by about 11% year over year for the last 20 years. Now, if you want safety, but you're also interested in growth, you'll have to chuck your desire for a higher dividend yield aside, but you got to go ahead and now double down on Microsoft, ticker symbol MSFT, which, as one of the world's biggest tech companies with an array of software, services, and solutions, and also hardware devices from laptops, tablets, and gaming consoles, just have a look at the last decade. It will speak for itself, delivering through on over 1,000% worth of share price appreciation. However, we will zoom in here to just the last handful of days. We're going to get Microsoft in the red from the recent tech sell-off, trading for $443 per share. And while it remains up overall on the year here, I say it's just a nice buy for the long term. So too do the analysts, projecting over 13.8% worth of upside, bringing that share price up to over $500 per share, $505.07. And while you should be all in here on Microsoft for that growth, well, I want to let you know that you're also going to get a nice chunk of a dividend here because it's got a 0.68% dividend yield that's been growing by a whopping 19% year over year for the last 20 years while maintaining a nice 17-year dividend streak. Now, investors, I want you to go ahead and comment down below on which one of these stocks that you actually own in your portfolio, or if you're planning on buying them, or a matter of fact, if you have better dividend stocks in mind for the week ahead, go ahead and let the whole community know. Comment down below. Feel free to enjoy more insights right here, but before you click away, be sure you're subscribed to the channel.